a difficult tape and a day where we're contemplating maybe rate cuts being pushed out even further. Oil is on some solid ground. It's up for a second day in a row. It is above $80 per barrel. This as the International Energy Agency warned of a supply deficit throughout the year. West Texas rose to a new high, as we can see, the highest level since November. Let's take a look at this. Our next guest says we could see oil move even higher to $85 per barrel. That's Phil Streible. He's Chief Market Strategist at Blue Line Futures. Phil, thanks so much for joining me. I'm starting to lose faith in the International Energy Agency and its ability to tell us what's going to happen in the energy markets, because they're full of warnings, and now here they are talking about a supply deficit.
You know, a product like crude oil, it tends to move and it makes these erratic moves here where the situation can really change. There's three main components when it comes to crude oil, at least from a trading perspective. You always want to look at supply, demand, and momentum. And the reality is that we were flush with crude oil a while back, and we also had, multiple conflicts going on in the Middle East, and crude oil prices were selling off greatly. But now, the resiliency of the U.S. economy, everyone was pricing in that we were going to have a recession. Now it looks like we're going to have no landing whatsoever. The economy is going to continue to take off. That's where that demand really picks up. And we're starting to see improvement in China and their economy. They are the largest consumer of crude oil. And then you start to look at the supply picture of things. You had a Ukrainian drone attack on Russian refineries, which could impact Russian exports. I saw a news article a second ago by the Financial Times saying that repairs could take longer than expected. And then you take the EIA inventory data, we're seeing inventories, they're sitting well below the 5-year average right now. So it's becoming much more of a tighter picture, and it's reflected with that 2% gain today.
And are those the factors that get you to 85?
I think so. I mean, it's also, it's not the strength of the economy is going to remain there. We don't see many cracks in the economy right now, so that drives the demand. When you get that first interest rate cut, that could act as a tailwind. If all of a sudden people have less debt payments to make on that interest, they can afford to start traveling in the most cost-effective way approaching the summer driving season is to take those road trips. So that's where that kind of smaller demand comes in. But really it's, when you get the EIA coming out with these inventory data projections of a build of 900,000 barrels and we get a drawdown of 1.5 million, it tends to have these shocks and these green shoots in the system. The yearly decline is about 33 million barrels sitting here, and we are well below, that 5-year average. So the 2024 demand is already increasing, and we're seeing upward revisions in 2025 and 2026.
Is that why we're seeing some of the refiners trade at all-time highs? That they have to buy crude, so typically they do better when it's a little bit cheaper. But is it because of the demand outlook for some of their refined products that is, propping them up?
Absolutely. And I mean, we've got significant gains. So beating away the crude oil market here today is going to be, heating oil moving up pretty aggressively, and also gasoline. So they will have to crack to provide those different elements there. It just seems like, the driving season is right upon us, and that demand is going to continue throughout. So on our wealth management side, we added Marathon Petroleum. We also added ConocoPhillips as well.
And I'd like to contrast that with the situation in gold, because you're talking about crude that's moving up and energy producers or any energy exposed companies that are moving up with it. That's not the case in gold. Gold is moving up. Those gold producers are not moving up with bullion. What do you think the disconnect is?
Well, definitely the disconnect. Okay, when you have prices going higher of the underlying asset and your profitability is not there, what you need to do as a miner is you need to produce much more gold, ramp up that output. And the problem that they have right now is they're faced with the higher energy costs, higher insurance costs, and higher labor costs. So that's where your disconnect comes in. You have to think from an investor, from a trader, why am I getting involved with this asset class? Is it because I'm a believer that the product like a gold, silver, copper, platinum are all going to rise? That's why I always make that argument. Just invest in the underlying asset. Don't go into things like buying these obscure miners that have other impacts that could happen, such as they have geopolitical risks, things like that. I personally have bought a mining operation that was in South America as an investment. And what happened was, is as soon as the discovery for raw materials was there, the foreign government came in and they basically nationalized it. So, you want to be in the raw material and really take it down basically what you're getting involved with.
That's interesting because bulls will point to a few things. One, that there's all this buying demand of physical bars, which helps your case on the underlying. But note that so many of these companies are trading at a discount to their net asset value. I try to speak to bulls about, well, what about Bitcoin? Is it possible that it's competition for some of these assets? Most are pretty dismissive, but are you so dismissive that Bitcoin is maybe a factor here as well?
Oh, at 100% it is. And that you could see that as relative to the ETF liquidation going on in gold. There's a disconnect between those two prices as well. What those people are doing, it was mostly short covering. People want to free up cash flow and they want to get into something like Bitcoin. If you look at when the GLD was launched in like 2004 and you go about 7 years out, it was the only product that was available for kind of the retail investor to get involved with in the gold market, and the financial advisors to allocate it into their wealth management process. So we saw gold go from $400 on up to $1,850 over the course of 7 years. So essentially at 4x. That's why we believe if you continue to get this investment flow into Bitcoin, we could see things from when it started around 50,000 and realistically a 2-3 year out time horizon, you could see Bitcoin at 250,000.
250,000 in what time horizon?
I said 2 to 3 years.
2 to 3 years. All right, Phil, we'll check in with you in 2 to 3 years about that, and I'm sure before that on a bunch of other stuff. I appreciate your view. That's Phil Streible joining us, Chief Market Strategist at Blue Line Futures. We're going to take a quick break. When we come back, there's been